Many people think that if they invest regularly, they will eventually become rich. But unfortunately, that's not the case. I know, that sounds completely insane, especially when everyone online is talking about how investing changed their life, made them millions, and helped them retire early. But here is what they don't tell you. Most of the people saying this, they found money to invest through other means and are not living off the investments. Now, don't get me wrong, I love investing. It's one of the best skills I picked up early in life and I've made good money with it. But I've also seen many people jump into it with the wrong expectations. They think it's a shortcut to wealth. And when things don't move fast, most people get frustrated and finally give up. I don't want you to be one among them. So in this video, let's talk about why investing alone won't make you rich, and more importantly, what will. So let's get started. If you're new here, my name is Srijit, and on this channel, we talk all about wealth and happiness. Now, I'm not a financial advisor. I'm just a random guy on the internet sharing my experiences. So please do your research before you act on any of the things I say here. Back in April of 2021, a European firm called Natixis did a survey. They asked 8,500 regular investors across 24 countries what kind of returns they expected from the stock market. On average, people were expecting around 15% returns every year. Now, here is the twist. When they asked 2,700 financial professionals the same question, the number was just 5.3%. So yeah, someone is definitely dreaming here. And if I had to bet on who is right, then my money is on the professionals. Because a return of 15% in the long term is simply unrealistic. I will explain why. For the market to grow, the economy has to grow. For the economy to grow, more money has to enter the system. And that can happen in only two ways. People earn more or people borrow more. That's it. There is no third option. But here is the problem. Both of these have limits. Let's start with the income. Yes, earnings can grow. People get better jobs. Businesses make more profits and productivity improves. But that doesn't happen endlessly. Wages rise only when companies can afford to pay more. And that depends on profits, efficiency, global demand, and a bunch of other factors. We can't just double everyone's salary every 5 years and expect no consequences. Inflation will catch up. Companies become less competitive, profits will dip, and job growth will slow down. Now, let's look at borrowing. This is an easy way to drive massive growth in the short term. Governments, they borrow money to build necessary infrastructure. Companies borrow to expand their business, and consumers borrow to spend. But here is the catch. We can't keep borrowing forever. Debt is simply money borrowed from the future to use today. And at some point, it needs to be paid back with interest. And eventually, the interest payments become too big to handle. And if the credit grows too fast, then something breaks somewhere else, like we saw in the 2008 financial crisis. Now, keeping all this in mind, let's actually do the math. If the whole market grew at 15% annually for the next 30 years, it will become 66 times bigger. Keep that number in mind, 66 times. Now, let's apply this to the Indian stock market, which is currently valued at about $4 to $5 trillion. So, considering a 15% annual rate, it would grow to $300 trillion in 30 years. For context, the entire global market cap is currently around $100 to $150 trillion. Now, ask yourself, is that even remotely realistic? Where will that kind of money come from? Who is going to buy, build, borrow, or spend at that scale? It's easy to grow fast when you're starting small. But as the base gets bigger, that kind of growth becomes harder and harder to sustain. And even if you think maybe not the whole market, but individual companies could still grow 300 to 400x, sure, some might. There are certain sectors such as AI, clean energy, biotech, and others that could explode in the near future. I agree. But the thing is, only a handful of people will catch that wave. Because when you invest in stocks, you are not going all in on just one. You are building a portfolio. And in a portfolio, the high performers get balanced out by the average ones. That's just how portfolios work. Unless you are a pro stock picker, your chances of beating the market consistently are pretty low. Most of us aren't that special when it comes to investing. I'm not. You probably aren't either. So the next time someone tells you that the stock market will give you 15 to 30% returns, take out your calculator, show them the math and ask, where is that kind of money even going to come from? Then what's a decent amount of return that we can expect? That's where the equity risk premium or ERP comes in. ERP helps us to understand what kind of returns we can realistically expect from the stock market and why all returns come with a price, volatility, and risk. I will explain. Let's say you have got some money to invest. Now you have basically two options. Put it in a government bond or invest it in the stock market. Of course, there are other ways, but let's keep it simple for now. Now, when you invest in a government bond, you are basically lending money to the government. They promise to pay you back with interest after a certain time. This is the safest way to invest your money because governments, especially stable ones like the United States, rarely default. So the return you get here is called the risk-free rate of return. Stocks on the other hand are a different game. You're buying a small piece of a company and if the company does well, then great, you earn. But if it doesn't or the market crashes, you lose. Now you are taking on more risk. So you should get a better return for the greater risk you are taking with the stocks. That's called equity risk premium, which is the extra return you expect for choosing a risky option of stocks over safe bonds. So the return you can expect from the stock market is simply the sum of the risk-free rate and the equity risk premium. Let's put some numbers to it. For US-based investors, the interest rate on a 3-month US Treasury bill is often used as a risk-free rate. This comes around to 3 to 4%, and the long-term ERP based on historical data is estimated to be around 5%. So the expected return from equities would be 5% plus 4% equal to 9%. But we are not yet done. This is still not the real rate of return because there exists something that quietly eats away our wealth even as it grows. Inflation, or simply the rise in prices of goods and services over time. And your real return is whatever you earn above inflation. So if inflation is 3% and your investment gives you 9%, your average real return would be 6%. That's a real return investors typically can expect over the long term. That's just math and that's the reality. And even if you take the conservative approach and assume a 10% return, still it won't be enough to make you rich because of one simple fact. You need money to make money. You could be the smartest investor out there, picking all the right stocks at the right time. But if you don't have a decent amount of money to invest, it won't move the needle that much. Let's say you follow the classic advice, invest 20% of your income. So if you make $50,000 a year after taxes, you would invest $10,000. Now, assuming a 10% return, that gives you $2,000 in gains in a year. Even though it's good money, it's not life-changing. It's not enough to get you to financial freedom anytime soon. Because along with money, you need another important factor, time. Most people get sold on the idea that you can get rich in the stock market in the short term. And let me tell you that it's just not true. You make money slowly over time. Like Warren Buffett once said, the stock market is just a tool to transfer money from the impatient to the patient. And the more I learn about investing, the more that line makes sense. So if investing alone won't make you rich, what will? I'm going to give you that magic recipe here. The fastest way to build wealth isn't by chasing an extra 2 to 5% on your returns. It's by increasing your income. Let me explain. Most wealthy people didn't get rich from stocks. They built businesses. They increased their income year after year. So instead of putting $1,000 into an investment, hoping to make $100, how about you just go and make that $100? Invest in yourself, build skills, start a side hustle, or sell something. I will say it again. Your income is what makes you rich, not your investments. That's how wealth is built. Now, just to be clear, this doesn't mean you shouldn't invest. Investing is a great way to protect and grow what you have already earned. And the good news is you can do both. Build a business, grow your income, and at the same time, invest that money smartly. Once you see investing for what it really is, a steady, long-term tool to grow and preserve wealth, you stop believing in those fantasy stories about people retiring at 23 because they bought one magical stock. Welcome to the real world. I hope you got some value from this video. If yes, then give it a like so that the message can reach more people. And if you want to see more related videos to save money and build wealth, then do subscribe to the channel. Until I see you with another video, have a wonderful rest of the day and adios.